why do people trade futures? Now, you and I have been very active in different worlds. The options world, you at a prop firm, me in the futures world, doing a number of different trading for myself as a local, trading at a prop group. Really, though, we never wanted to, at the end of the day, own 100 shares of stock, or God forbid, have 1,000 barrels of oil, or $1 million Kiwi dollars that we're asked to be paid for. So very different part. And I think we talked a little bit about this with expiration. It was always something that we were mindful of, rarely found a lot of opportunity around, but realized, I think we talked about, in my world, the idiot tax of getting out of the delivery cycle. So, but you know what? I think it's a good point to talk about the world of futures. It's just not a world of guys looking for a directional assumption and a capitally efficient way to do it. So why do people trade futures? And, let's start a little bit with the discussion of something that is very much in the traditional space. Boy, bad job of me centering up slides here. Let me do a little bit better work here. Let's talk about the idea of, and we can walk through, and I'm curious to see your thoughts. Something like corn. Obviously, that is relatively straightforward, but let's talk about that piece. In your mind, in your world, who uses a corn contract except you and I to sell a relentlessly rallying corn contract that is very difficult to sell trade from the short side? So who else in your mind is using these like a physical future, like corn futures?
Yeah, so I think that's a valid question, because like one of the things that I think that I'm interested in today's topic is because of exactly what you just said. Most of the people that I know that trade corn are basically speculating. I mean, they're speculating on either direction or maybe even vol. A couple of weeks ago, vol was a little bit elevated, but I don't know many people who actually do it for the original reason, which is, and even then in that, the dynamics are interesting to me, but I don't know many people who do it with they're trying to actually hedge something. I'm not sure of those. So, I mean, what are those use cases for that?
Well, and you know what, you hit right on it. They're looking for hedging and price discovery. They're looking for what is the price in the future. So a classic example here is you've got the farmer growing a crop. Now, corn and soybeans have been planted in late March and early April. They're growing right now. No one knows what that November or December bean or corn contract, what they call new crop or what's growing, how much of it there's going to be. So as a farmer, you're looking for a way, okay, I know what my seeds cost. I know if I'm renting land or my land usage, I know all the inputs that go into water, fertilizer, everything. I know those costs. What I get for that crop is uncertain, because I don't know if the price is going to be $7 a bushel as it is today, or $8 or $5. And that part of the process is an important part of decision-making for the farmer, not only in terms of what crop to plant, but a lot of times farmers, if you're borrowing money to finance a crop, the bank or the insurance company will require you to hedge that position. So
in this case, that farmer is long corn.
Absolutely. He is the natural long. And, the glue of a futures product. Now, all those speculators and market makers going back and forth is part of the glue, but a successful futures product, and when I mean successful, one that's liquid, that we could trade, has this end user involved in it. There's got to be, I like to call it three legs of the stool. There is the market maker, the short-term speculator like you and I, and the long-term end user who has a use for the product. And when you bring those three components together, you get a product that has a lot of volume and open interest, like corn futures. So you've got that one side of the equation, the farmer. Then you have the other side, the end user, whether that be a feedlot that, again, one of the over half of all the corn produced is not used for us consuming corn or corn syrup or any of the other byproducts of corn, but is for feedstock, right? For cattle, hogs, and chickens. Absolutely. So They're that end user. Now they've got their own set of, I've got a calf that weighs 400 pounds. I'm taking them to a feedlot. They've got to take them from 400 pounds to 1,200 pounds. One of those inputs is corn. How much is that input? How can I hedge that input? I know I got to pack X amount into this guy to get him to get to 1,200 pounds. What is that input going to cost me? Because depending on where cattle prices are, I can fatten a calf that is that I put too much into that I'll never sell, like redoing a house and overdoing it and never being able to turn around and sell it for what you put into it. So sure. You take in these two end users, and this is a very important part of the market. So this is why futures were originally built, because no one had certainty as to what that future was. So the efficiency of being able to determine who uses a product. Now, for us, it's a two-edged sword. And the takeaway I'd like to have from this is, okay, these are participants that add a ton of long-term liquidity to the market because they are your people holding open interest for a long period of time. Open interest gives you volume and liquidity. Yep. Are we going to try to guess our farmers who are natural longs and the consumers, the institutional consumer, whether that be the silo operator or the feedlot operator or again, someone using corn syrup to manufacture food goods? We can't guess what they're doing. And I think it's a futile attempt to try to figure that out. Yeah. But that is understanding that part of the market exists is a really important concept. So that end user is trying to do the same thing. They're the natural short. We've got the natural long, which is the farmer, the natural short, which is the guy who needs corn and needs it at some point in the future. He is producing some sort of byproduct, whether, again, it'd be corn syrup, corn starch. Corn is used, I'm going to get my facts around here, but I think 15% of all the corn produced is, I'm going to see if you can get a guess, because I never knew this until I read it. What do you think corn is used for?
Well, I feel like I would have said it. I would have already said 15% of it is used to feed. Honestly, that's what I would have said. I'm
okay.
Not sure.
Okay. It is actually, it is used in an energy way. Corn makes ethanol. So there's corn ethanol. I know. I was listing through.
No, I should have.
What are all the things that I eat?
I should have.
Short of corn on the cob. That was one I didn't know either, but I thought that number was huge and it was fascinating. So there is an interesting energy component into corn. We're putting some context out here. This is kind of a step back piece. And there's so many different variables. And we've got to be mindful of understanding those dynamics. Now, there is a correlation between corn and natural gas. You think two more random things in the world are corn and natural gas. What in the world are they? Well, when corn is harvested, it needs to be dried. Natural gas is the primary input for drying corn, so it can be stored. So there again, natural gas is an input. If it's more expensive to dry that corn. I can get less for it. So all those things tend to play in. There's a number of different variables. We don't want to track everyone, but understanding the influx of these different dynamics, different use cases it's funny for me. You talk to Tom, Tom's like, I don't even want to know this. I don't want to hear about it. Doesn't matter.
I do, though. I like this kind of stuff. This is exactly why I knew this would be interesting.
See, and you and I, it's not necessarily part of our decision-making process in our world of looking for tradable volatility or tradable direction, but it's context, and context put in the right place completes the circle for me. I think it does. It makes me feel more vested, but I think you need to compartmentalize it. When you're starting to guess that there's going to be a great crop or there's going to be a poor crop, the market is going to reflect that in terms of somebody looking at a 30-day model in terms of weather that is far more advanced and very kind of bespoke and made that will be reflected in the market price. So we're not agronomists, we're not weathermen, we're not all these things, but understanding those pieces is an interesting piece of content, because oftentimes we want to get a little context around movement, and that helps us not decide whether I want to be long or short, but understand the market and its dynamics a little bit better. So getting back to this piece is good. Compartmentalizing it, though, is really important. I think you've done that. Trading so many thousands of different single names and the options on those, you're not drilling down to look at, their, I don't even know if I got
price,
their
ratio,
4Ks. Right. And,
I could care less about that stuff. You're right.
right.
But it's important to bring that context though, like, because for whatever reason, like the idea of that's something I'd never heard about natural gas in the part that's used to be drying corn. It's important to know these type of things. Like you said, it's important to compartmentalize too.
Right.
But I like being aware of these things. And I think there's a lot of people who are, all of the different circumstances surrounding pricing, so that when the pricing is doing something that most people that you may be, paying attention to or following or whatever reason saying, oh, this move is ridiculous, you at least have some understanding as to why maybe it's happening.
Yeah. And that, I think, shaped, you're so spot on, Jermal, because that doesn't change the shaping necessarily of your ideas, but gives you a little bit more market awareness.
Yeah.
And I think that's an interesting piece. And you know what? I think we're both, that inquisitive part of understanding context is important for me too. And it just, does it become... One
last question before we move on from corn.
You bet.
Does the farmer is aware of how much they're going to actually be feeding, their crop, their cattle, et cetera. Do they factor that into their hedging? Or not?
Absolutely. So they will, and it's a great question. So a farmer who's planting corn knows the cost of the seed, if he's renting the land, what that contract is now. He knows the cost of fertilizer. He knows a lot of those inputs as he's planting that crop. Now, he does that math, and now over 80% of the acreage in the United States is what they call substitutable. And again, this is like a compendium of facts that I want you to put everybody put in context.
Partially owned by Bill and Melinda Gates, apparently.
Right, which will be an interesting piece. But it's 80% of it is substitutable, which means you can plant either soybeans or corn. So the farmer will look at, okay, here are my inputs if I plant corn. Here are my costs if I plant soybeans. Now, if there's and here is the future price of where I could start to sell and hedge my future crop. So that is that price discovery of, and this is why we always look at so many products where all the liquidity is right up front, like in S&Ps, in T-bonds. It all sits in that 90-day window. And you look at these corn and November beans, and it's like, my God, they're doing hundreds of thousands of contracts. Mm-hmm. The reason why is it's such a critical component to know and base decisions on for this entire planting year. So they will make those determinations. If beans are relatively richer in terms of inputs and what I can sell them for now, you'll see more beans planted than corn. Now, as that comes out, as that story unfolds and is reported, you'll see the market prices adjust to that predicted supply, whether or not it comes through or not. So you're absolutely right. All those inputs are part of their decision-making process. And you would think how hard it would be to guess at it. It really would be a guess. What do I plant? How much of it do I plant? Is this a year where I'm going to rotate my fields to give them a chance to, again, planting the same type of crop in a field every year diminishes the amount of yield you get out of that crop. So there tends to be a rotational cycle. So part of this is just the ability to know ahead of time what I can sell that for or what I can buy that for. Is that critical need? When you have need like that, that is one of the reasons markets are successful. So oftentimes we look at, why is this trading and why is it trading so much? And a lot of time it doesn't come back to, oh, it's an incredible speculative tool. It comes down to there's glue in terms of this end user price discovery. And that's what makes them very, very interesting. So same thing, walk us through here on the financial services, on the financial products, no different.
So, yeah, banks use futures to help hedge their exposure to various currencies and financial instruments. And I think, here it's, and you can correct me if I'm wrong, but I feel like it helps to understand how banks sort of operate, right? Because typically they borrow money at short-term rates because we get CDs and, whatever have you, although there's no interest rate on those for the last however many years. And then they lend out money at longer term rates for our housing, right? Like we borrow money from the bank for houses and they lend it.
Right.
So that's how they work. And I'm sure they find different ways to hedge their exposure via dollars probably, or, somehow, or what do they do? Well, interest rates, right? Those interest rates they use.
Right. And that's a perfect example. So by the definition of their business, they borrow short duration, they lend long. So what becomes a problem if short-term borrowing costs or what they have to pay consumers rises and long-term rates don't rise in the same way. So they've got what they call a duration mismatch. So you're right. I need a way to deal with that in the future because I'm lending something for 30 years and I'm getting paid only for 90 days. So there is a material mismatch of the time money is out my door or in my door, as you mentioned. So there is your end user.
And so last year, it probably just happened way too fast, right? I mean, for them to even bother to hedge, there's no way they were prepared for
it. They weren't, but you know what? You saw, and part of the reason, like one thing we don't trade a lot of, but is almost half of like CME's volume is Eurodollar 90-day interest rate futures. Why? It is the benchmark of short-term lending. That piece you're talking about, that 90-day CD in our world, that 90-day rate is that linchpin for the institutional world. So that is where you go to hedge short duration, T-bond futures or ultra T-bond futures, or where you go to hedge long. But same type of participant use here. We don't guess what banks are doing, but there is someone who has a natural interest to hedge one side and a natural interest to hedge the other, just like the farmer. So it's the same kind of buy play. That's why these markets are so interesting. So dollar participants, same thing. You think about a guy who is producing, in the world, widgets, farm implements in the US and selling them to China. Now, what's his risk there? He knows all the costs of putting them in. He knows what he contracts to sell them in China being paid in yuan. What's the challenge there? What is that yuan going to be worth to that producer in a year's time? That is that price discovery piece that needs to be hedged. That's where the currency piece becomes so important. So people use futures to gain exposure to stocks, commodities, and more using less capital. That's one of the important pieces for us.
Yep.
The important piece too with futures is, so we've talked about that end user and price discovery. That price discovery, that hedging is really important. But what do you think one of the additional benefits of futures, and this is not an easy question, of futures are in terms of using them for that end user we've been talking about, that farmer, that manufacturer? Where is a future a better vehicle than some other type of price discovery vehicle?
I'm not sure.
Okay. It's what you had just mentioned. It's the margin piece. It's the capital efficiency. Okay. So I can go out and hedge my crop. I'm required to post some capital to do it, but it's not an overwhelming amount. If I put all these resources into buying a seed, planting and everything, and then the hedge costs me as much as what it was planting, I'm almost in an unsustainable situation because the financing cost of that overwhelms anything I'm going to make on them. So futures become this great vehicle because of their leverage, because of the ability to gain simple exposure and gain it in a very efficient manner. So a little bit different context. This was fun to really walk through. And you know what? I went through that same process and it's great to be able to I kind of kid, these are cocktail party facts. They're great little pieces. Are they the way you and I make decisions? Not for the most part, but it's interesting that we're both guys who need pieces of the puzzle to best feel equipped to trade the markets.
It's helpful to know. I mean, like I always say, you don't have to know how to build a car or put it together or change the oil or the engine to drive one. But it's important to know that if all of a sudden the gauge is going up and it's down hot, maybe something's wrong. You might want to check your radiator, or there's all these different things, right? Like it's important to know these things. I mean, yeah, catalytic converter has a lot of platinum in it. Who cares, really? But it's important to know. It's interesting to know because all of a sudden, when people start stealing catalytic converters, you know why.